So hello everyone, and welcome to another one-to-one mining investment APAC online content session. Today, to speak on the outlook for the gold markets, we have Samson Lee, Senior Metals Analyst at Refinitiv GFMS, Wayne Gordon, Executive Director for Commodities and Foreign Exchange at UBS Wealth Management, and Gavin Wendt, Founder and Senior Research Analyst at MineLife. Welcome everyone to the panel.
Hi, thanks for the invitation.
Yeah, thanks, Amy. Nice to join you.
Great to have everyone here today. And so I guess to kick things off, maybe we can speak a little bit about, the price of the gold right now. Is the gold rally over, and where do you think the price is going to go from here? Maybe Gavin, do you want to kick us off?
Sure, happy to. Well, it's an interesting question to start off with because a lot of market watchers will equate gold's recent price performance with COVID-19. I think investors will look at the commodity sector broadly and say that COVID-19's had a big impact, both negatively and positively. If we go back to March, we saw significant falls right across the board with commodities. But since March, we've seen significant recovery right across the board, and gold has been no exception. So a lot of market watchers will say that gold's rise is relatively recent and it's tied in with COVID and safe haven demand, and that's true to some degree. But I think for perspective, it's interesting to go right back and have a look at gold. And if we have a look at a gold chart over the last 20 years, we see that gold has come from below $300 per ounce back in 2000. Ironically, when the Australian Central Bank was selling off 2/3 of its gold reserves because it didn't think the price was going to go anywhere. So gold has transformed itself. It's gone from $300 per ounce or below to a high of $2,050 per ounce just recently. So I think what that shows is that gold's ascent has not just necessarily been a modern phenomena. Sure, it's been perhaps exacerbated or underlined by recent trends, but there have been some significant factors, some fundamental drivers that have led to gold's price increase. And even if we look at a more recent sort of perspective on gold, 5 years ago at the end of 2015, gold was trading at around about $1,050 per ounce. And of course, recently we've seen the gold price at its height almost doubling in that period of time. And if we go back to 2018, just 2 years ago, gold was trading at around about $1,200 per ounce. And at its maximum just recently, gold has increased by about 2/3. So if we look at gold in context, we can see that there are very sound drivers that have underlined why the price has performed as strongly as it had. And it's not just a recent phenomenon.
Samson, maybe you want to jump in? Share your thoughts?
Yeah, sure. I think it really depends on your time horizon. In long term, let's say I'm pretty confident that before the end of year 2022, I think the gold price should be trading at least like close to $3,000 US. However, if you're asking like month and next month, I think it is very complicated. And to be honest with you, I think the chance of the gold price going up is just as much as the chance of going down, because like this month and next month, I think the global financial market will be very volatile, surrounding mostly about the possible outcome of the US presidential election. To be honest, we don't even know if there will be a postpone on the election day or final date, or just too much uncertainty surrounding right now. And I'm a firm believer that no matter who wins the US presidential election, I think the US stock market will crash, or there will be a big time correction, no matter who wins. So like right now, the market tries to make people to believe that if Trump gets reelected, then the stock market will be more stabilized, but I don't think that's the fact. Because even Trump gets nominated again, I think there will be no more positive good news to continue to support the stock market. But for gold, it is very difficult to predict whether it will be dragged down again by the stock market, like what has happened in March, or it will act as a safe haven asset and then like bounce up against the falling equity. So like I think in the next 2 months at least, it is very difficult to predict where the gold price will go. But to put it simply, I would suggest people better waiting at the sidelines, and whenever there's a big volatility in the gold price, for example, if it drops too much, then it's a good time to buy.
And Wayne, maybe you want to jump in here and share your thoughts.
Yeah, just from our perspective, we have gold prices forecast around this sort of 1900 to 2000 mark over the next 12 months. A little bit of the basis to that from our perspective is, the first point is the two key, I suppose, short-term drivers of the gold price are real interest rates in the US, being a function of nominal rates as well as inflation expectations. And the second thing is the direction or the broad dollar strength or weakness that people expect over the next 12 to 18 months. Of course, the volatility index or volatility in equity markets is also another key contributor to our gold price expectations. But if we just leave that aside for a minute, we would expect that base effects, at least on inflation, will see real interest rates in the United States take another step down into the first half of next year, potentially seeing the proxy for US real rates being the TIPS, the US government bond TIPS, falling down to, on the 10-year level, down to around a negative 1.3%. And then on the dollar side, we actually expect that, just taking the euro dollar, for example, we actually expect that we will see broad US dollar weakness over the next 12 to 18 months, potentially pushing the euro dollar as an example back into that 120 to 125 range. So those two factors themselves would promote gold prices around that sort of $2,000 an ounce, based on the historical sort of correlations with those factors. But the structural question for me is, from the asset management or asset managers' point of view, given where US government bonds are, given that we still have inherent risks in financial markets, even once we have a vaccine, we think we get a vaccine more broadly available in the second quarter of next year. But even once we have that vaccine, how quickly it gets distributed and how effective it is will be then the questions that arise. So the consequence of this is that we do have inherent uncertainties in market throughout most of 2021, albeit growth should continue to recover. So the key question for me is how asset managers continue to see gold within a portfolio context. And that is more based on expectations for bond yields being very low for a long time. Traditionally, when we've looked for insurance against equity market volatility and broader market volatility, we've tended to hold US Treasuries as that element of insurance. We don't think that US Treasuries from this point provide the same insurance that they have done in the past, largely because rates are very, very low already. And so we see gold increasingly being context. We know that we need dollar weakness to encourage investors to continue to buy gold. But the question mark for us is, longer term, how do asset managers see gold within the portfolio context? And that will give some different scenarios to perhaps not the next 6 months for gold, but 12 months and thereafter.
And
Amy,
I guess, yeah, go ahead.
Sorry to interrupt. I'd just like to follow up a couple of the points that Wayne made there in terms of factors that are helping to support the gold price. And I think what we're seeing at the moment is a continuation of some of those factors that I was alluding to that have taken the gold price over the last 20 years from sub 300 to almost 2,000, over $2,000 per ounce, record highs just recently. Low interest rates, we haven't seen interest rates recover to anywhere near normalized levels since the GFC. Central banks, particularly the US, have left interest rates at ultra low levels. And that has led to a situation of negative real inflation, as Wayne was talking about, where the real inflation rate is well above where nominal interest rates are, especially in the US. And that creates a fantastic environment for gold. And it also creates a challenge for central banks, because when interest rates are left at ultra low levels, it creates financial bubbles like we've seen in the share market, like we've seen in various other assets around the world. It discourages saving. But at the same time, what it does is that it creates a situation of incredible volatility. And it also leads to a situation where central banks don't have the firepower to fight the next financial crisis. And we're in the midst of a global health pandemic and a financial crisis until recently. We're not quite sure how it's going to work out on either front. So, I think what we're seeing with gold at the present time is we're seeing gold go through a consolidation phase. It hit a record high, almost close to 2,100. It's consolidating. And until we get some clarity around Trump and the election and whatever is going to happen there, I think right across the commodity space, we're going to see commodities pretty much in a holding pattern. And I think we typically see this in the lead up a couple of months before every US federal election. But once that's sorted out, I can see all of the factors in place to see a very, very strong gold price performance from 2021 in the years to come. If we have a look at the GFC, gold didn't hit its record high until 3 years afterwards. And what we're seeing this time around is the fiscal measures that have been implemented in the mega trillions dwarf what was thrown at the GFC to try and get the economy back on track. So with all this extra money out there floating around, negative real interest rates, uncertainty, I think it creates a fantastic foundation for gold over the coming years.
Absolutely. And I guess just curious to see, has Trump's COVID diagnosis kind of made an impact on the market so far? Like, have you seen anything so far directly attributed to that? Anyway.
From my perspective, not necessarily. I think everything still seems to be in that election holding pattern. There's been some recovery in the US dollar, and I think Wayne alluded to that as well. I mean, I think the outlook for the US dollar is questionable, and that, of course, provides fertile ground for gold prices. But I think at the moment, everybody's waiting and seeing, and nobody's too sure about what's going to happen. 2020 has been a crazy year already. Just when we thought things might be starting to settle down as we head in towards the US election, things seem to be getting crazier.
Yeah, absolutely.
Just on that point, Amy, I think there's a couple of things that have been impacting at least the gold price in the very, very near term. One has been the Fed have given off very mixed messages. So they brought about their average inflation targeting, which suggested that they would let inflation run hot before they began to move on rates. Since then, Fed members have delivered very mixed sort of messages about with respect to further easing, additional easing across the duration of the rates curve, i.e. buying longer dated bonds, etc. And so I think from that perspective, that's created a little bit of uncertainty from the gold side. But I think one thing that the COVID situation has done is strengthened the dollar a little bit, not just the Donald Trump situation, but also the fact that we've seen cases pick up in Europe. We've seen restrictions begin to be increased again, at least not at a broad-based level, but a regional level, also in the UK. And that has seen a bit of US dollar strength. And those sort of mixed messages from the Fed caused real rates to lift a little bit, albeit still in negative territory. The one point I want to make about real rates, though, is that it is often the direction of real rates or the trend in real rates that's important. The level of real rates, while supportive, does not historically drive the direction of the gold price. So it certainly doesn't erode the gold prices, or at least gold's benefits, but it certainly doesn't drive the direction of the gold price. So inflation expectations, which have rolled over since Jackson Hole, have created this sort of mix with the stronger US dollar to put a little bit of downward pressure on gold. But the point I would make is, if we look forward, an election of potentially a Biden presidency, which as has been said, it's very uncertain. The polls are very, very close. We've been burnt before by taking polling too seriously. But certainly an election of a Biden president would add that extra volatility in the markets, but moreover, it would induce higher fiscal spending, particularly if he was to win both houses of government. It would induce additional fiscal spending, which requires further issuance of government debt, which then leads the Federal Reserve to need to at least step up those purchases to keep yields low. Otherwise, what we'll see is a much sharper steepening of the yield curve. So it is important that the Fed get their signals more consistent and they become more dovish across the board to keep longer end yields, at least sort of the 10-year level below 1%. And I think that's very important, at least for the short-term view on gold.
Yes, I think in the big picture, like as I mentioned before, like no matter who wins the upcoming US presidential election, I think it doesn't matter. There will be a kind of relatively more significant pullback in the stock market. And we'll have to wait and see what's the impact in another stock market correction will have on gold. But in the short term, things definitely have been much more complicated once Trump has been admitted that he has been tested positive in COVID. Because like what happens next? For example, like will there be a postpone on announcing the results? And then if Trump loses, will he like handle his power over smoothly, or will there be a conflict of power struggle? We all don't know what's going to happen. So that's why I think in this month and next month, I think the financial market will be very volatile. And then also, I have to admit that this year so far, physical buyings have been the major force pushing the gold and silver price up. However, like in recent months, it is obvious that people start taking profits and selling some physical back in the market, although the amount has been quite minimum compared to their buyings so far this year. I think that's because before the presidential election, people began taking profits, getting more cash, waiting on the sidelines and see if there are more opportunities to buy later. And so far, as I have seen, people in the futures market has not been buying or longing gold contracts at a substantial amount. So most of the forces that pushing the gold price up has been by buying physical metals through ETFs or bars or coins. But in the last month or so, they have been drying up, and even they have been taking profits and selling back some of their physical metals back in the market. So that's why we are seeing the consolidation right now. So again, in the next 2 months, it is very difficult to forecast in which direction the gold price will go. But in the longer run, like next year and the year after, I'm very positive the gold price will go far, far higher. Just as Gavin said, low interest rates, more volatility in the financial market should be positive to the gold price.
Yeah, absolutely. I guess looking at the physical markets, does anyone else want to kind of touch on some insight on what's happening there and where you think where you see things moving?
Maybe I'll start first this time. Well, like last week, I wrote a report saying when the gold price was like trading at 1850 or 1860, I wrote a report predicting that gold price was down too fast within too short of period of time. And I think there will be a technical bounce, which has happened already. It's now trading at hovering around 1900. One of the reasons is, I think it's because the Chinese went to holiday in the first week of October due to Labor Day. In the past, I observed that there is a situation that whenever the Chinese go to a long holiday in October, the international gold price was usually trading far weaker than usual, because normally the Chinese gold price has been trading at a premium over international price. So Chinese go to a long holiday, the support of the gold price has gone missing. So it can easily be explained how come in the last few years the international gold price was trading notably weaker in the first week of October. However, this year has been different because since March this year, the Chinese gold price has been mostly trading at a discount to the international price. In August, the Chinese gold price has been trading at an average of $72 discount per ounce to the US dollar price. So this month, with the Chinese mostly going to holiday, I think to the opposite to what has been happening in the last few years, the weaker hands from China have gone to holidays, and the pressure being created on the gold price has now gone. So I think there has been a technical bounce on the gold price when the Chinese have gone to holidays. So right now the question is, once the Chinese get back from holidays, will the gold price be pressured going down again for the short run? I think it is possible.
Gavin, I don't know if you want to weigh in here at all.
I've listened with great interest to what Samson said there, and look, I don't particularly have that much to add, and I don't want to go off topic here, but just one of the interesting things, I guess, from my perspective about the market, and it's a slightly different theme, but this time around, there seems to be on the part of gold producers, there seems to be greater fiscal discipline, if you like, something that's probably been lacking in previous gold booms over the last 20 years. Gold companies themselves seem to be showing a lot more restraint in terms of developing new projects, simply running with the projects that they've got and trying to increase efficiencies, not flooding the market with new supply, not bringing on lower grade deposits, not engaging in, takeovers and acquisitions and all of this sort of stuff that we've seen in the past. And, I think that's playing a major role as well, because investors, and I'm sure Wayne's got more to add on this particular topic, but investors in the past have been burnt many times over by gold companies that have failed to deliver when the gold price has performed, and it has over several decades, even taking into account the pullbacks that we've seen in the consolidation in price. The margins for gold producers have been quite exceptional, but that hasn't flowed through into consistent gold company profitability and dividends and returns to shareholders. So, and in the current environment where gold investors have more choice, it's not just simply about physical gold or gold equities, there's ETFs, and now there seems to be talk about cryptocurrencies and all of that sort of thing as a potential rival, which I don't necessarily agree with, but the spotlight is on companies and performance. And it's encouraging, at least at this point in the cycle, that companies seem to have learned, the bigger companies especially, seem to have learned from the lessons of the past, mistakes of the past.
Wayne, any thoughts on that?
Yeah, let me pick up a couple of things. Firstly, on the demand side, it's always been the case that as gold prices rise, the demand for jewelry and so forth, which we know can be a significant proportion, anything between 45–50% of demand, tends to begin to drop off. And we've seen that again this time, albeit the shift in rates and the type of dynamics that we've witnessed in the market have meant that the ETFs have seen record inflows over the first half of the year. Now, as we, I suppose, we look into 2021, part of the reason why we did have that acute weakness in jewelry demand is linked to the impact of the COVID crisis on movement, etc., and ability to get to gold retailers and so on in some of those areas of India as well as China. So I guess the key question as we look into 21 is that even at these elevated prices, will we see jewelry demand begin to recover? And alternatively, as we see investment flows potentially begin to fade, unless we get a significant risk-off event, I suppose the inflows do begin to moderate as we go into the back end of next year. Can the jewelry demand, etc., support overall demand for gold as we go into the second half of next year? That one I'm not quite certain on yet. I think, as I say, traditionally we've needed to see prices set back before we've seen a pickup in broader demand for jewelry. But if prices are expected to remain elevated, and perhaps not at current levels, but even at levels around the sort of 1700, 1800 mark, my view would be that we could start to see support for gold through those demand for jewelry and so forth from those key customers come in at much higher price points than what we have seen in the past, which is supportive even if gold prices do weaken into the second half of next year. That is a supportive element that we haven't seen come in at those sort of levels in the past. Just on the production side, I would completely agree with Gavin that gold companies underperformed the underlying gold price for around about a decade, from the record gold price we saw back in 2011 all the way until very recently. We've actually seen a bit of a closing of the gap between the index performance of the underlying and gold miners themselves. And I think in part, for example, we've even seen investors like Warren Buffett, who have traditionally shunned gold producers at any point in the cycle, have actually made reasonable advancements of positions into gold miners, seeing this valuation differential emerge, and that discipline that gold miners have shown that they are willing to distribute back to shareholders. They are willing to pay dividends across the cycle. And from our perspective, we've actually had gold miners as a preference through this period, because we saw that discipline and because we saw that distribution back to shareholders potentially remaining even as gold prices, if gold prices are to set back moderately in the second half of next year. So when we box all that together, I guess we do have that preference for the underlying and the preference for the miners themselves. But we do have to remember, from an investor standpoint, the reason you own gold is not the same reason you own gold miners, in the sense that the volatility in gold miners is around double that of gold. So if you own gold because you believe it can protect you in times of illiquid markets, it adds diversification to a portfolio, it does help you hedge against upside to inflation, upside to the US dollar, downside to the US dollar. Those elements are the reason you own gold are somewhat different to the reason you add gold miners in that context, because of that volatility differential and what it does add within the broader portfolio context.
I would just like to add one small thing.
Mm-hmm.
It's like, I think back in year 2019, I think I wrote something that from year 2008 to year 2018, the gold price cumulative return is like about 56%. And then at the same time, the gold mining index, the return is like negative 50%. So the difference between the two asset class, the physical gold and the gold mining index, is like over 100%. That's crazy, right?
Mm-hmm.
Of course, as Gavin and Wayne mentioned, there were reasons of the underperformance of the gold mining equities. But as long as the management of the gold mining companies can fix their acts, I think there will be huge catch up and huge upside in the gold equities in the longer run compared to the physical gold price itself, because they have been lagging too far behind. However, I would like to stress one important point is that in the last few months this year, I think there's a very troubling sign that I saw is that some of the better performers in the gold equity sector are companies that hold projects that are very low grade because investors simply want to bet on higher leverage gold projects. However, from a fundamental basis, if a project doesn't work when the gold price is trading at, say, $1,500, it may not be economic when gold price is $3,000 as well, because even when the gold price is at $3,000, the cost of producing the gold ounces may rise as well, or even at a larger magnitude than the gold price has risen. So I think people have to be very careful and selective when they are investing in gold equities, especially those mega-sized projects that requires, let's say, over $1 billion capex, very low grade. When people like trying to bet these kind of projects may work at let's say $3,000 gold price, but in reality they may not, because usually these mega size projects may take a very long time to develop, and by the time the companies have invested a substantial amount of capex in the project, the bull cycle may be close to an end. So who knows?
Gavin, I don't know if you want to weigh in here, looking at kind of these investment trends. No.
Well, it was interesting the numbers that Samson put forward there in terms of the stark gulf between the returns of gold companies and the gold price performance itself. And I guess that ties in with what Wayne was telling us earlier. And that's a really interesting differential, a point of difference to make, which is that, there are different reasons for owning gold as to owning gold companies. And it seems as though in previous booms and busts that investors have taken on all of the inherent risk of gold miners without any of the upside. But fortunately, that seems to be changing. But what's interesting, I think, moving away from the gold producers to the gold hopefuls and the explorers, and we've got a lot of them in the context of the Australian marketplace, if I can just talk about my backyard. We've obviously seen a lot of money coming into the sector. It's been staggering, actually. I cannot remember the last period, the last 6 to 9 months, we've seen so much money coming into the junior end of the sector here, and most of it is going into the gold space for companies to go out there and explore or appraise existing deposits and try and commercialize them. And obviously that's been driven by the underlying gold price. At the same time, though, there have been some inherent advantages for Australian gold companies in terms of margins. The fact that the Australian dollar has been lower. We've also seen the oil price trading capped at around about $40 per barrel, and the cost of diesel is a major cost component. And I think it ties in with what Samson was saying, is that, it's not just all about the gold price in terms of making money. There are a whole lot of other variables there that determine your operating margin. And, if you've got to go out and borrow a large amount of money to fund a project, that all has to be factored in: depreciation, amortization, your operating costs, all of that sort of stuff, currency. At the end of the day, companies have to make a decision around the return on investment. And if they're an existing, relatively high grade gold miner, and they're looking at taking on a lower grade deposit simply to add production ounces, which seems to have been the argument over previous booms, let's get bigger, let's take advantage of the gold price. Well, as we know from the evidence, that hasn't been, a route to success. In fact, quite the opposite. And we're only at the stage now where investors are starting to come back to the sector and look favourably on it again. But it's encouraging at the small end of the market to see that junior companies are able to raise funds. And I think they've got this attitude that if they are going to commercialise projects, the encouraging part is that it all seems to be about grade, high grade, which will generate a robust margin. So the projects that are going to be commissioned, whether they do it themselves or whether the project's acquired by an existing player, we're looking at margins and profitability and return on investment rather than just ounces for ounces' sake.
I was just going to say, I think that's a good place to kind of start to wrap it up, unless Samson or Wayne, you have any kind of final thoughts on the gold market, gold outlook that you want to share with the audience.
Yeah, can I share a screen?
Yeah, sure.
Okay. Well, I think earlier this year, like maybe around June, I did an online interview with Neil. And then at that time, I already forecast that the gold M&A market may start cooling down in Q3, which has actually, this is what has been happening so far, because the market was too hot in the first half this year. So I think the whole gold sector needs a healthy correction or kind of cool down period. So in the first graph, we can see that the number of total gold resource adds have been like going down in the third quarter. However, it is still like kind of higher than the second quarter of last year. And then surprisingly, the largest acquisition, M&A, in the third quarter was like involving a project that was only hosting like about 2.6 million ounces of gold, which is quite small compared to the previous quarters. Because, for example, in the first quarter and in the second quarter this year, there were at least, I think, 7 to 8 deals with individual deals that involving the gold resource like over 3 million ounces per acquisition. So I think people are starting to cooling down as the gold price have been running too fast and too high. So the buyers may be getting reluctant, try to like stay on the sideline to wait for a pullback in the gold price and then try to make an offer. And then the second graph is we are seeing the acquisition cost per resource ounce has also been going down compared to the second quarter, but it is still at a substantial level higher than what has happened in the first quarter. I think the reason to explain this is because the majority of the acquisition in the first quarter was involving the low grade, the lower quality projects mostly. So that's why I think the acquisition cost per ounce in the first quarter was like only around $25 US per ounce. While in the third quarter, the average acquisition cost per ounce is around like $53 US per ounce. And then in the third chart, we can see that obviously the most geographical location that people goes to are Quebec and Western Australia. But in the third quarter, the number of cases going to Quebec has started to be going down compared to the second quarter. And while the incremental rates in Q3 going to Western Australia continue to increase compared to the second quarter, but obviously the incremental rate has been decreasing as well compared to the increase in the second quarter. And then more people has been going to other relatively not so hot jurisdiction in Q3. For example, like Nevada, Newfoundland, and Mexico. So that means people like Quebec and Australia are getting too hot, and then people are starting to go to other areas that they find are more prospective and higher chance to make a big discovery. And the fourth chart is, despite I mentioned that the number of cases involving resource answers have been decreasing in the third quarter, but the number of cases in terms of sticking ground, JV, and royalties deals have been increasing in the third quarter. So that means while the market sentiment in the gold mining sector has been cooling down in the third quarter, but it is still hot in the longer run perspective. Like if you compare it in the last few years, the gold sector is still hot in the third quarter, but the industry insiders have been shifting towards the earlier stage projects, trying to start working on projects that does not carry an existing resource, possibly because the price of working on a project or buying a project that has an existing resource is getting relatively too expensive right now. So people are working to earlier stage projects at the moment.
All right, great, Samson. Thanks so much for sharing that with us. Wayne, I'm not sure if you had any final thoughts before we log off.
The key points I want investors to think about is the next leg down in real interest rates, the diversification benefits of gold within the portfolio context, and the weaker dollar bias that we have over the next 12 to 18 months, which should be supportive of the gold price, but be mindful of any discussions around tapering from the central banks as we get closer to 2022.
Absolutely.
Thanks, Amy.
All right, thanks everyone. And thanks again for taking part in this Gold Outlook panel. We look forward to seeing everyone again soon at a live event.